Well, on that point, let's get our market master for the day. Prabhat Awasthi, Head of Equities at and Managing Director at India Nomura Financial Advisory, is joining us. Good morning, Prabhat. Thank you very much for joining us. It's quite some time since we spoke with you. Well, first up, of course, the markets. We have seen a minor resistance put up by the markets in their relentless fall ever since the last 8 weeks, or almost ever since the budget. Do you think this market has a lot to lose, or do you think it has discounted most of the perhaps unwarranted exuberance of the earlier months?
Well, I think there has been a very large correction. You have seen a lot of domestic cyclicals give off substantial amount of gains they had made post the new government coming to power. In fact, in dollar terms, I think index is down. A lot of domestic cyclicals are below where they were after the new government came to power. So just going by that, there is obviously, I don't think there is that much exuberance left in the market. The multiples in the market are 15.4 times. The lowest they have been in last 1 year. So clearly, at least as far as valuations are telling us, as far as valuations of domestic cyclicals are telling us, there is not that much exuberance in the valuations. I think it's probably somewhat other way around, because the valuations are trading at a discount to last 5-year averages. Which tells me that you essentially started to worry a bit more than in terms of looking forward towards future with more hope.
Okay. Prabhat, hi, morning. So not much exuberance in the markets now. Well, the last time when we spoke with you, you had a December 2015 Sensex target of 33,500. Given the kind of headwinds that we have you scaled down your Sensex and your earnings estimates for FY16?
No, first of all, the headwinds are more in the marketplace. I don't think... And there have been some headwinds to earnings, which we had already factored in because we thought that the near-term earnings estimates were a bit too optimistic. So, if you look at the data on the ground, I don't think data has got any worse. The real data, that, as I call it, we have seen decent numbers on IP. We have seen decent numbers on inflation compared to where we were 6 months ago. We have seen, decent numbers on BOP. Some demand indicators are starting to look up. Government finances are looking much better. So in terms of real economy, I don't think we have seen additional headwinds. I think growth is consolidating and improving, and the inflation is well under control. So it is the marketplace which has seen headwinds. And part of that probably is because of the earnings correction, which happened because of commodity prices falling, which happened, which started in September, October, sort of continued well into March. And that impact on earnings was quite pronounced. But barring that impact, I think generally the earnings trajectory in the marketplace will start to pick up towards the second half. So we basically think that the basic tenet of of a positive view on the market that was that the economy will improve, that the macros will remain benign, nothing has changed. In fact, if anything, things are beginning to improve. So we don't really feel a big need to cut our market target. I also believe that if you're sitting in a earnings season which is poor compared to a season which we believe will be stronger as you go into the second half, the multiple can change quite quickly in the market. So if you start believing that the earnings trajectory is starting to improve, then you could actually end up seeing market multiples move quite swiftly. And therefore, I think that our view on positivity on the market is more on the exit sort of conditions end of this year than the conditions with which we have entered into the market in the beginning of the year.
Fair point, Prabhat. Actually, the industrial output numbers, for all their eccentricities and volatilities, have been showing a steady uptick, and they have never lied about the direction, even if they lie about the intensity.
Correct.
So, I mean, I take your point with both hands. It sounds nice to hear this as well. But what is the quarter in which we can see the earnings turn, and which would be the sectors where we would see that earnings turn?
So I think the earnings will probably remain at these levels. So kind of slowdown we have seen will persist for another quarter. Maybe and it'll start, the base effects will start getting better from September onwards. So I think December quarter will be better, and the March quarter obviously will be even better, because the base effect will be of the commodity prices would have been fully surprised in. I think we have seen the worst in terms of basically earnings in the last quarter, because while we have seen the full commodity price impact on the overall earnings, we haven't seen fully the impact of on the downstream companies, because of the fact that inventory cycles tend to be large. There are lags in realizing the benefits of lower commodity prices. So I think that impact will probably flow in to the next quarter. Also, I think the fact that government revenues are doing much better than expected, and the fact that government will start spending, and also the fact that all the initiatives on railways or roads or mining will start to have an impact on the demand side conditions, and the economy will all be sort of plugged, or will all be visible in the second half. So we think that every quarter from here will be an improvement. The real big improvement will probably be visible in the second half of this fiscal, with the last quarter being much better than. So it will be a sequential improvement every quarter, I think. Now, where will we see it the maximum? I think so earnings recovery will happen. I think across the board. Obviously, one where I think it will probably become more and more pronounced going forward will probably financials, because we are starting to see, we probably start to see a better NPA situation maybe in 6 months, after 6 months, and that can actually drive the earnings growth quite sharply. There will be some credit growth recovery towards the end of this year. We are starting to see automobiles tend to do better. So domestic cyclical, cement, etc. will start to do better. So I think end of the day it will be an overall recovery, but where the depression in the earnings is the highest, save aside global cyclicals, because they are determined by global prices, their earnings. In the domestic cyclicals, if the margins are too low, then there will be recovery in those margins, apart from volume growth. So that it's basically cement, banking, industrials, those kind of sectors will see more recovery than the rest.
Okay, you touched a chord when you spoke about credit growth and NPLs.